Hello class. Today I want us to talk about the books of original entry. The books of original entry, they are also known as the prime books. They are also known as the subsidiary books, commonly known as the journals, the day books. Sometimes they are also called the diaries. These books of original entry, or the journals, as we are going to refer to them more often in this particular chapter, they are the books where transactions are first recorded. Before the transactions are even transferred to the ledger accounts, they are normally recorded in the books of original entry. And the books of original entry, they are actually classified as follows. We have got the sales day book, or the sales journal, which is actually a book that records all the credit sales. Very important to note, the sales journal. Remember, sales, we are selling goods to our customer. If we sell those goods on credit, all those customers who bought goods from our business on credit, they are going to be recorded in the sales journal, or the sales as the book of original entry. And of importance there to note, it is the word credit, not any sales. Goods that are sold on cash basis, or are sold and check is received from them, they are not recorded here. Only those goods which are sold on credit. And therefore, the sales journal, remember those customers who buys goods from us on credit, they are normally known as the debtors. So this is a case whereby now we are going to have a list of all the debtors in a particular financial period. It is going to contain the list of all the debtors who bought goods from the business in that particular period. Again, I want to emphasize here, it must be credit. It must be credit. If it is cash, then it is not going to be recorded here. We have an illustration here where you are to enter the sales journal from the following details. Post the items to the relevant accounts in the sales ledger, and then show the transfer to the sales account in the general ledger. Here you are told 1st June, goods were sold to Michael on credit, and they were amounting to 1,800. On 4th June, they were sold to Herbert, worth 2,000. On 7th June, they were sold to Jessica, 900. On 9th June, they were sold to Cecilia for 50. On 16th to Andrew, 1,390. And on 21st to Richard, 380. If you are told to record this in the sales journal, this is actually the format of the sales journal. It has the column for the date, whereby we record the date the transaction took place, or the date the customer bought those goods. Then we have got the details. The details will capture the names of those particular customers who bought those goods. Then the folio, which is actually the page that particular transaction is appearing. And then we have got the amount, the value of the goods that were bought on credit. So you find here the date, we find all the dates as recorded here, and then the name of the customers, they are going to be replicated here. Then we are going to have the amount. If in the question, in an examination scenario, there is no folio, don't even bother to put the column for the folio. You can simply have the date, detail, and amount. In some cases, you can find a case whereby you are given the invoice number. Remember, when we were talking about the books, source documents, when we were talking about the source documents, we said with that source documents are those documents that give us or act as evidence that a particular transaction happened. You will find that the sales journal, it is going to rely on the invoice as its book of original entry. As a source document. You'll find that the invoice is going to serve as the source document here. And note again, we said an invoice is normally issued by the seller to the buyer, demanding for the payment for the goods already delivered. The buyer bought goods on credit, but at the moment they have been delivered to the buyer, Then the seller will send the invoice giving the detail of those items that were sold and the total amount that is supposed to be paid. So that now becomes the source document. If we can have all the invoices that were issued to our customer, we find that. And not forgetting, when it comes to the invoice, we have got two types of invoices. We have got the invoices we call incoming invoices, and we have got the invoices we call outgoing invoices. In this case, the incoming invoices are going to be for the purchases journal. Remember, an invoice is normally prepared by the seller. If it is sales, then it simply means that we are the seller, and therefore we are the ones to issue the invoice, and therefore that invoice, because we are sending it out to the customer, it is known as the outgoing invoice. So the source document for the sales here is going to be outgoing invoice, and then in some cases you can find the invoice number, so you can insert the invoice number as a column here. But most questions we find that they are normally omitted, and the date, details, and amount columns will serve the purpose. After doing that, remember all these customers who are listed here, they are known as the debtors because they were they bought goods from us on credit. If we were told to prepare the account, then you will find that we are going to find the account for each and every person, and because they are debtors, they are going to be debited. All of them are going to be debited with the amount that they bought and the date that they bought. And because they were sales, the particulars here is going to be sales in all cases because goods were sold to them. That's why it is appearing as sales. They are debited like that. Another book of original entry is what we call the purchases journal. The purchases journal now records credit purchases only. Credit purchases only. And in that case, the source document for the purchases journal, it is going to be incoming invoices or invoices received. Remember, for the sales, we said it's outgoing invoices or invoices issued. In the same manner, you'll find that the purchases journal is going to be prepared almost the same way. We are going to have the date, details, invoice number, folio, and the amount. And in this case, you find that the invoice number and the folio, in most questions in your exams, they are going to be omitted. If they are omitted, you don't include these two columns. You just have the date, details, and the amount. Remember, purchases, it is the business that is buying goods. So the business bought goods from Ken. It also bought goods from Timothy. Remember, these people, because they sold goods to us, they are known as the creditors. They are known as the creditors. So in preparing the ledger accounts, you'll find that it's going to be on the credit side. And now the particulars here is going to be purchases because the business purchased from them. And then the total amount is normally transferred to the purchases ledger. Then another journal or book of original entries known as the return inwards, also known as the sales returns. The sales returns are normally the sales that were made and the customers returned those particular goods to us. So you find that those goods that were sold maybe to the Jessica and all that are appearing here, you might find that those customers, because of one reason or another, they might return. The moment they return those goods, they are normally issued with the credit notes. So when it comes to returns, their source document is normally credit notes. Remember, we said a credit note is a document that is normally sent to the buyer to correct an overcharge. The moment a customer has returned, the amount that was in the invoice that was issued in the first instance is going to be more because the goods have already been returned or part of the goods have been returned. So the credit note is going to be sent now to correct that overcharge. Now you'll find that the credit note, they are also classified into two. We have got the credit note that is called the outgoing. The outgoing simply means it is us, the business, who is preparing them. And then the incoming, it is now sent by the person from whom we bought the goods in the cases of purchases. So the outgoing credit notes, they are for return inwards or sales returns. And here, the key point of understanding this is that the credit notes is normally prepared by the seller of the goods. Because it is us, or it is our business that sold goods to these customers who are returning them, then we are responsible in preparing the credit note and send it to them. Because we are sending to them, that's why it is called the outgoing credit notes. And you find that it's going to be almost the same, but this column is going to be quite different. Instead of having invoice number here, we write the credit note number. But note, the source document for return inwards is actually the the outgoing credit note. And then when it comes to the ledger accounts, we normally record it to the return. Actually, because sales, remember when we sold to them, we debited those accounts of those customers, but the moment they return, we normally credit their accounts by the return inwards and the amount of goods that they have returned. Then we have another document called the return outwards journal. Return outwards journal, it is now going to record purchases returns. It is going to record the purchases returns, and the source document for return outwards is actually the incoming credit note. And you find that now is going to be like this. Because purchases, when we purchase goods, we normally credit the suppliers who sold to us. It is normally, but when we return to them, we debit those particular suppliers by return outwards, like that. Therefore, we have an illustration here. Like, for example, you are told the credit purchases. We said anytime we have got credit purchases, this automatically goes to the purchases journal. When we have credit sales, it goes automatically to to the sales journal. When we have the credit purchases, again, it goes to the purchases journal. Credit sales, it is sales journal. Return outwards goes to the return outwards journal. Return inwards, it goes to the return inwards journal. Credit sales, it is sales journal. Credit purchases, purchases journal. Return inwards goes to the return inwards journal. Return outwards goes to return outwards journal. And you'll find that it's quite simple. You have got the date, the detail, and the amount. This is the sales journal. So you only pick the sales journal. Like, for example, here, if we have got this particular kind of a scenario, the first or the transaction where credit sales was involved, here, the 3rd of October. The 3rd of October, you'll find it is going to be here. They were sold to whom? They were sold to Rick. So Rick is here, and the amount was 5,100. Raps, it is 2460, the same date. And then also Raphael, 3560, like that. So you just list the date there as indicated here, and then the person who bought those goods and the amount, like that. Then you go to another date, like for example, there is another credit sales here, the credit sales to Stephen. So you come to the date, you record the 8th, Stephen. They were also sold to Stella, the same date, you record and the amount, like that. You also locate where we have another credit sale, you record like that and like that. And then the total credit sales is going to be this, which is actually the sum of this. If you are told now to prepare the ledger accounts, you open the ledger for Rick, Raps, Raphael, and all that. Raps, like example, somebody like Raps is appearing twice. You record it twice like that. Remember, all these are debtors, so the ledger accounts are going to be debited by sales, like that. You record it like that, and up to the point whereby you are finished all of them. Like, for example, here, you can have a case like Rick. Rick had bought goods of 5,100, and on that, he returned some goods worth 300. Because he returned, you record it on the credit side. Remember, in accounting, when you record 5,100 on the debit and 300 on the credit, it is like saying it is 5,100 minus 300. So the person is supposed to give us or to pay 4,800 for that case. So a debit and a credit on the same account, it is subtracting. And we are subtracting this amount from here because these goods have been returned. So we cannot expect Rick to pay this, yet he returned those goods to us. That's why we are subtracting, so that we can get the balance. It is actually as simple as that. When you go to the purchases journal, it is actually the same. You write the name of the person who sold goods to us, the credit, you record them here, and then the amount, and then you total the amount to get the total credit purchases. When you record now this, remember this now, if it is the purchases, these people are the creditors because they demand money from us. And that's why they are going to be prepared like this. You'll find that now they are going to be credited by purchases. All of them are going to be credited. In case we return goods to them, then we record them on the debit because we are subtracting this amount that we are supposed to pay. They are recorded on the other side. Two debits simply means addition. But if it is a debit and a credit, it simply means subtraction. That's how we normally prepare them. The same case to the return inwards. Remember, return inwards will come from debtors because it is people who bought from us, now they are returning to us again. Whereas return outwards, they normally originate from purchases because it is the people who supplied us goods, but we are returning the goods back to them. So these people are our suppliers or creditors, whereas these people are our customers. Note that. And that's how we do it. The last book of original entry I want us to look in this particular lesson, it is the general journal. The general journal, it is normally used to record things which don't qualify to be recorded in the four that we have discussed. Here, remember what goes to the sales, purchases, sales returns, and purchases returns, they are only goods. And from the onset, I've simply said that goods are items that are bought with the aim of reselling them to get profit. Anything else which is bought by the business which is not meant for sale, then it's not a good. And a good example here, they are fixed assets. If the business buys goods asset or sells goods assets, they cannot be recorded as sales because those items are beyond the normal business operations. So if, for example, we buy maybe a motor vehicle on credit, we cannot record it on purchases because that is not a good. If we sell a furniture, then that cannot be recorded on the sales because furniture is not good. You'll find that now these items, they need to be recorded in the general journal. Sale and purchases of fixed asset on credit terms, they are all going to be appear here. And also things like the bad debts written off, they are going to be recorded here. Correction of errors, they are going to be appearing in the general journal. And you find that the general journal has got a slight difference in terms of format. It has got the date, it has got the details, and for your debit and the credit column. So you'll find that the details, it is going to be two accounts. Anytime you do a transaction, remember we said from the ledger, we have got two accounts that are going to be affected. One to be debited and the other one to be credited. In the details column, always start with the account to be debited. Always start with the account to be debited and you write that amount on the debit column, and then the amount to be the account to be credited, and then you write the amount in the credit column. This folio is not important and it's normally omitted. So you can simply have a column for the date, details, debit, and credit like that. And then you normally give a very brief narration or explanation of what has happened. We have an illustration here. Bought a motor vehicle on credit from Kenya Motors for 96,000. Because it is actually a motor vehicle, it cannot be on purchases. So you'll find that if we buy a motor vehicle on credit, then you find that a motor vehicle is going to be debited because it's an asset increasing, and then Kenya Motors is going to be credited because these are creditors or they demand payment from the business. So you'll find that it's going to be appearing like that transaction here. You write here motor vehicle or vehicle account and you write the amount, and then the person whom is going to be affected is Kenya Motor because it's our creditor. You record the amount on the credit side here like that, and then you can give a narration to record purchases of vehicle from Kenya Motors Limited on credit like that. I hope you have enjoyed. We shall meet in our next class. Have an enjoyed moment.